Is streamlined financials for entrepreneurs. And I just want to give a shout out to Babson College in Boston. They run a program called WinLab for female entrepreneurs. So they just ran that in Miami. It was a 5-month program here. And I ran the financials portion of that accelerator. So it was 17 female-led startups. And as some of you know, I've been working on a financial model template for the past few years. So this was kind of my road test to see it in action. And I'm in the process of launching that as a product that entrepreneurs can use. So the idea is, it's not just a template, but it's actually a spreadsheet model that's really easy to use. And so you can hop in there and build out your financials very quickly. So this was part of the course that I taught to Babson, but I think it's useful to everyone. And really the elephant in the room right now is obviously this virus. Hopefully you all are doing well. I actually know a fair number of people in New York where I used to live who have caught it, most of whom are doing okay, but some of whom are not. And obviously, our entire lives have changed. We're all trapped at home. I was doing a lot of work with a mobility startup that was encouraging public transportation and ride sharing and scooters and bikes. But of course, that came to a screeching halt because no one's mobile at the moment. So, all of us are having to pivot. Now is actually a great time to start a new business. It's also a great time to pivot. Some of the greatest businesses were born during recessions and downturns. But obviously, that's a factor. And that's part of the reason I want to do this right now and focus on financials, because this is how we're going to not only survive, but thrive during this period. So what we're going to cover today, financial projections, really helping entrepreneurs get a handle on the numbers, even for non-financial people. Most of the entrepreneurs I work with are great with product, they're great with customers, they're not as great with the financials. So I'm trying to make this simple for people. We'll briefly cover the 3 financial statements. The income statement, also called the profit and loss, the cash flow statement, and the balance sheet. I can actually do a separate session that's a deeper dive on those, so we'll just touch on those. Cash and accrual accounting. The 3 financial statements use a different combination of cash and accrual accounting, so I'll talk about what that is, and those are 2 things that work together. Cost of goods sold, or sometimes called cost of sales. This is, what it costs you to make and deliver your product. It's a little bit different for physical businesses than for virtual or subscription businesses. I'll touch on that. We'll have some fun with business models. I've put together some cool visualizations that we'll run through that I think will help you as you start to design your businesses and think about the business and revenue model that you want to build. And then we'll do Q&A. Again, I got a bunch of questions from you all up front that hopefully I'll cover most or all of, but again, feel free to unmute yourself and ask questions as we go through this. I've been a mentor and advisor, an entrepreneur. Sorry, I have to admit people here. Great. So I've been a mentor and advisor. I've been an entrepreneur. I've been a software developer. I've raised money. One of the companies I founded had an exit. I've worked with a ton of other companies and startups since then. Hold on 1 second. Let me mute people. Great. And so I just have a ton of experience with this, and consistently, I see people struggling with the financials. And really, finance is the language of business. Like, a business is about money. It is about making money. It is usually about making more money than you spend. Although we've obviously had some high-profile examples of companies that don't do that. But for most of us, we're going to try to build businesses that actually make money. And when we go out to investors, they want to understand, if they're handing us hundreds of thousands or millions of dollars, they want us to have a credible plan for how we're going to responsibly spend that money. So they want to see, a decent financial model. And if we're not raising money, if we're using our own money or we're earning money from customers, we also have a responsibility to spend that money wisely. We have a responsibility to our customers, to our employees. There's lots of reasons to get the finance piece right. And I've tried it two different ways. I had a company called Tonic Studios back in the 1900s and early 2000s. Yes, I'm that old. And I tried doing this. I had a business partner. Neither of us were good with numbers, and everything worked great up until the .com crash. And then there was a day where we just ran out of money, and we had to lay off most of our employees. He took half the list, I took half the list, and we had to lay people off, and it sucked. It's one of the worst days of my professional career. And I realized in retrospect that we had been running the business without understanding the numbers. As long as we were growing, we could pay the bills, but as soon as there was a hiccup and the revenue dried up, we had no cushion, and we didn't even realize it. So again, it was a little irresponsible, or a lot irresponsible, to our employees and to our customers, because obviously our ability to deliver for the customers who were paying suffered when we laid people off. So after that, I decided, listen, I'm going to figure this financial thing out. Eventually started another company called Slide Rocket, and with that one, we had a real financial plan. We raised a couple $1,000,000 from a venture capital firm, and then we used the financial model that we had presented to the investors. We actually used that to run the company. So, and we did a pretty good job. It ended up getting acquired. So the second time around worked much better once I understood the numbers. And so then after the exit, I started working with other entrepreneurs, and I started building the financial models for them, thinking I was doing them a favor. If they don't understand the finances, I can just build the model for them and then they'll be fine. But I realized I was actually not doing them a favor. I was doing them a disservice, because they had this fancy model, but they didn't understand it. They didn't know where the numbers were coming from. If they were talking to investors, they couldn't explain the numbers. If something changed, they didn't know how to change the assumptions. It actually ended up not being good at all for the entrepreneurs. So then I started thinking, okay, is there an easier way? And that's the financial model that I keep saying I'm on the verge of releasing. But I'm really focused on getting this thing out the door. It's a spreadsheet template that's easy for entrepreneurs to use. You can enter your assumptions. You don't have to keep typing into lots of little boxes. But it's easy for you to update. Like once you do it, you spend an hour or two, and then you really understand where the numbers are coming from, but the spreadsheet does most of the work for you. And really, the difference between running a business and a charity is whether or not there's money left over after you pay all your expenses. Again, it turned out during the .com crisis, we were running a charity. Claude, do you have a question? I'm just going to mute you again, but feel free to unmute yourself and ask questions if you want. Okay. And so I'm just going to spend 2 slides on this, but really success comes when you get the product right, when you have a market, when there are customers out there, and when you manage things responsibly. Another way of putting that is, if you want to successfully execute an idea, you need to successfully validate that idea, meaning that customers will buy it. You need to successfully market and sell that idea. And then it's that same thing at the end, you got to successfully manage it, right? And the management piece is where the finance comes into play. And a lot of companies are finding that out during this virus crisis. They weren't managing as well. They didn't have the cash cushion. They're in trouble now. And so the financial model is how we run our business. So I'm going to give an overview. I'll give you some links, some useful information. Again, any day now I'm releasing this new financial model template. So I'll be in touch with that. I think we've covered, I got questions from most of you. Is there anything, if you have any other questions, you can either ask them now, just unmute yourself, or just unmute yourself as we go through this. Feel free to interrupt. All right, so here's the template, the financial model template that I've been recommending. This is a pitch deck slide. And so what it shows here is it shows 3 years of financials. I think 3 years is about as long as anyone can predict in our current reality. I used to do 5 years, but that's way too much now. So 3 years seems to be good. And it shows on the right, you'll see a summary of each of the years. And then on the left, it breaks out year 1 by month. And that's the piece, when you flash this up on the screen, investors really want to see that granular level in year one so they can understand how the business is doing. And we'll talk about the other stuff. But the reaction most people have when I flash this up on the screen is they start to hyperventilate, right? They see a lot of numbers. They start to freak out. They don't know what they mean. So we'll try to demystify that by the end of the hour here. And one thing I've done is actually simplify that model a little bit. So I took some of the numbers out. So this is kind of the same thing. Year one, year two, year three summaries on the right. But now the summary on the left just shows the first 3 months broken out and then the next 3 quarters. And this doesn't necessarily mean January to December. For some entrepreneurs, it does mean January to December. But really, there's 2 strategies. One is I'm raising money. So month 1 is the first month after I raise money, which could be any month of the year. And there's a separate approach, which is month 1 is now. I'm going to run this business and I'm going to have a responsible financial plan. And somewhere along the line, I'm going to raise money and then I'll be able to ramp the expenses. But this is my real operating budget. And this is something I can look at, I can take to my stakeholders. I highly recommend running your business off of this as well. Again, it's a lot of numbers. We'll talk about what they mean. I also want to say I've updated, I think some of you have seen this, but I do a walkthrough of the pitch deck slide. And so if you want to grab this URL, actually I can type it into the Zoom window, I think. Let's see. That includes a lot of the information that I'm giving you today. It also includes the 2 templates that I just showed you. So feel free to grab it, feel free to use it. I'm trying to make everyone's life easier here, including my own, but also yours. All right, so when we look at all those numbers, what happens? People freak out, right? They see all those little boxes, they see all those little numbers. And what confuses people, as far as I can tell, first of all, it looks like a lot of math. Second of all, there's lots of little boxes and people don't know what the little boxes are. Third, money is always in motion. And that's the piece that's a little hard to wrap your head around. Like just because it looks like I have money in the account today doesn't mean I'll have money in the account tomorrow. And some of the financial statements don't accurately represent exactly how much money is in my bank account. So those are all solvable problems, but you gotta learn. Cash versus accrual confuses people. I'll talk about that in a minute. And then there's different types of costs. There's cost of goods sold, there's operating expenses, there's capital expenses. I'll cover those also. So let's break it down. The math, first thing, the math is easy. Most of it is addition, subtraction, multiplication, and division. There can be some complicated algorithms, but mostly you're dealing with this. And then, a subset of division is percentages. So everything I showed you on those slides is one of these things: addition, subtraction, multiplication, division, and percentages. So don't be afraid of the math. And really what I showed you is how much money you're bringing in minus how much money you're spending equals a profit or a loss, which is how much money is left over. I know it looks more complicated than that, but that's it. And so really what you're working with are 3 main financial statements. They are the income statement, also called the profit and loss, or P&L, the cash flow statement, and the balance sheet. And I'm going to talk about all 3 of those briefly, but let's also take a second to talk about cash and accrual. So cash basis, accrual basis, those are accounting terms. The income statement is on the accrual basis, cash flow statement is on the cash basis, and the balance sheet is on the accrual basis. And that's why the 3 of them work together, because they each show things, they relate to each other. And some of the numbers are the same, but they each, you need all 3 to have a complete picture of what the business is doing and where it's going. And so the cash basis is the same way I run my wallet. I have $50 in my pocket. that's how much cash I have. If I go buy a Starbucks coffee, I pay, they take the cash immediately, and I no longer have that cash in my wallet, and Starbucks has my cash. That's the cash basis. The accrual basis is more like a credit card. So what accrual means is the money doesn't actually change hands immediately. So with a credit card, if I go to Starbucks with $50 in my pocket, I walk out with a coffee and I still have $50 in my pocket. Starbucks has received an IOU for the cost of the coffee, and I owe the cost of the coffee, but I haven't paid it yet. That's the easiest way to think about accrual. So cash works like the cash in your wallet. Accrual basis works like a credit card where there's a lag on when the money actually changes hands. Businesses use both of these. There's not one that's right or one that's wrong. They're just tools. And I'll do a deeper dive on these in a minute. And so again, the three financial statements: income statement is on accrual, cash flow statement is on cash basis, balance sheet is on the accrual basis. So let's start with the income statement. It's also called the profit and loss statement. It's also called the P&L from profit and loss. As we've said, it's typically on the accrual basis, although if you're in QuickBooks, you can view it on the cash basis. It doesn't show important cash items. If you have any kind of inventory, that doesn't show up on your P&L. Accounts receivable, which is money that other companies owe you or customers owe you. And deferred revenue, which we'll talk about in a minute, but if you're running a subscription business, you may have taken a year's worth of subscription fee up front, but you only recognize 1 month worth of that subscription fee every month. We'll talk about that scenario in a minute. It doesn't include the cash you raise from investors. It doesn't include money you borrow with loans. So there are important cash items that don't show up on the income statement, which is why you can actually get yourself in trouble if you're trying to keep your company alive just with an income statement. You also need to look at the cash flow statement to understand how much cash you actually have. And it doesn't include capital expenses. So capital expenses are expensive computers, like your Mac, your $3,000 MacBook Pro, land, building. If you're manufacturing things, it's the tooling or the molds that you're using to manufacture, but not the raw materials or the inventory. And there's also some non-cash items on the income statement like depreciation. So depreciation is the decline in value of a physical item. Like your MacBook Pro becomes less valuable every year because Apple releases powerful new computers. So that's called depreciation. So here's a piece of what I showed you. So revenue is revenue. Cost of goods sold is one set of expenses, and that gives you the gross profit and the gross margin. We'll talk about those in a second. But that essentially says how much money it took you to make the product or service that you sell. And then you need to pay all of your operating expenses out of the gross profit. That's the money left over to run the business. And then that gives you a profit or loss called the EBITDA, which we'll define in a second. But in this case, you can see I made $7,000. Well, actually, I took in $14,000, spent $7,000 of it making the product, and then had $72,000 in operating expenses. So I ended up $65,000 in debt. So this is a company where I'd probably need to go raise some money from investors in order to make this work. But essentially, you're just taking revenue minus costs, and it's leaving you with a profit or a loss. One thing that really helped me, and has helped some other entrepreneurs I know, is doing their own bookkeeping. It forces you to come face to face with the three different financial statements. A lot of people use QuickBooks. That's what I'm familiar with. But one of the guys I know, he's got 8 guys in a room, and he's built a business that does hundreds of millions of dollars worth of fish sales. So when you walk into the Whole Foods, like his business provides a bunch of the fish. But it's one of the most successful businesses I know. And he started by doing his own bookkeeping. So he really got to understand the numbers. And obviously he's pretty good. So costs, there's the cost of your product and service. There's the cost of people. Typically with a lot of the technology companies, people are the biggest cost, salaries are the biggest costs. And then there's everything else. So we'll run through these really quickly, and then we'll have some fun with business models. And one piece of advice for startups, and this was in some of the questions you asked, revenues tend to be imaginary until you really find product market fit. Up until you find product market fit, you think you're going to sell a bunch of whatever you're selling, but the customers don't necessarily agree. And there's a little bit of a dance while you figure that out. But that whole time, the expenses are real. So I really recommend, especially with the virus, be conservative with your cash. It's hard to get cash, right? So make sure that you're being conservative with it and you're spending it wisely.
Hey, Mike, can I ask a question?
Yeah.
Is it okay to jump in as you were saying?
Yeah, jump in.
This is Dane, by the way. Good to connect.
Hey, Dane.
It's been a while.
Good to see you. How you been?
I'm good. I was going to ask, so we are raising a seed fund and we just did a revenue model. How important is it at that stage to actually also do, the expense side of it and actually, putting some estimates and assumptions on the cost of goods sold and, other fixed costs and things? Is that absolutely essential to do the expense side of it, or is it dependent on the business and whether you just do a revenue model, or how does that work?
The short answer is I think it's essential, because I think you still have to run the business responsibly even when you raise someone else's money. Like, you still got to figure out the expenses and have a path to profitability.
Yeah.
The long answer is, it may be that the investors you have don't necessarily need to see the expenses. So you may be able to raise money just off a revenue model. But eventually, one way or the other, you're going to have to figure out the expenses. So I would suggest spending the time now to at least get a rough draft going. I think what also happens, like one of the things I've found with this financial model that I've been putting together, this template, is it forces people to go through all of the expenses as well as like the sales model. And so it plants the seed inside their head where they understand the framework and they understand all of the pieces, even if they don't know the answer, right?
Yeah.
So even if I don't know how much my rent's going to be, I at least am thinking that I have to pay rent. Even if I don't know how much the insurance is going to cost, I'm at least thinking that there's going to be an insurance cost.
Yeah, I'm with you.
So I recommend doing that just to start the process of mentally cataloging everything that's going to go into the business.
Got it. And as you said, at least have something if they ask, because I would feel silly if they asked and I had, I didn't have anything to show.
Yeah, like you're asking them for hundreds of thousands or millions of dollars.
Yeah.
So it's like, I don't know, you want to convince them that you're going to spend it responsibly.
Right.
I think. That being said, when we raised money for SlideRocket, we raised $2 million from a venture capital firm. I swear they never looked at our financials. So it's not.
I mean, at Rome, we just had a revenue model too, and so that's why from past experience we didn't. But I think in the post WeWork era, it's probably good to do, like you said, at least have something.
Yeah, WeWork kind of blew up the.
I think there's a WeWork world and a post WeWork world. So
Yes.
Cool. Thanks, man. Appreciate that.
Yeah, no worries. I am all for responsibly running the business with or without investors.
Right. Yeah.
But I can just tell you what I've seen. I can't tell you your truth. But when you account for costs, so you've got cost of goods sold, which we kind of touch on. We'll talk about a little bit more. But that's what it costs to create your product or service. You have the operating expenses, which are running the business. That's the bulk of the salaries and the rent and insurance and lawyer and accounting fees. You have interest, taxes, depreciation, and amortization. Some of this stuff isn't really important at the beginning, but it becomes more important as your company grows. And then you have capital expenses, which, as we covered, is laptops and buildings. Each of these has a catchy name. So cost of goods sold is called COGS. Operating expenses is Opex. Interest, taxes, depreciation, and amortization are the I, T, D, and A in EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And capital expenses are called CapEx.
Mike, a quick question. Yes. Sorry, Sanjay.
Yeah.
I've heard this term amortization several times. What exactly is it?
Okay, so depreciation is the loss in value of something physical. So when I buy a laptop, the next year that laptop is worth less because there's a brand new laptop that's more powerful. Um, and so what amortization is the same thing, but for something intangible that's not physical. So usually that's like if I buy another company, that company's brand starts to lose value over time because it may no longer exist as an independent entity. But I paid for the brand as part of the purchase price of the company. So most of the time, we on this call probably won't have to deal with amortization, but it's essentially the decline in value over time of non-tangible assets. Okay. And a lot of what I'm going to show you, is because the accountants want it that way. But it is useful to understand this, and I really wish I had understood this stuff the first time around. As I said, I got myself in trouble. So this is your abridged guide to navigating this stuff. And I'm going to move pretty quickly. We can actually do another session that's a deeper dive. Cost of goods sold, what it costs to create and deliver your product or service. So in the old days, this was raw materials, and it was the labor to manufacture and finish each product. Right? So I'm selling widgets, I got to buy whatever I put into the widget and then do some work to create the widget. In our new world, our online world, customer service goes in here and hosting costs go in here. But what doesn't go into the cost of goods sold for online is the cost to develop the actual software. And that is weird. That always confuses me and it confuses everyone else. But for an online business, the cost to build, or any technology business, the cost to build the software goes into operating expenses. So quick math lesson here, cost of goods sold. If I'm selling a device for $249, and there's something in physical manufacturing called the landed cost. So that's what it costs to build my product, which I used to do, let's say, in China before the virus. The landed cost is what it costs to build each unit and then ship it. So it lands in the US, that's the landed cost, $90. And that's the cost of goods sold. And we can calculate a few things from this. One is we can calculate the gross profit. So the gross profit is a dollar amount, and it's simply revenue minus the cost of goods sold. So in this model, it's a $249 retail price minus the $90, which is the cost of goods sold. That gives me $159 of gross profit. And that's what I have left over to pay all the operating expenses and other expenses for the business. We can also calculate the gross margin percentage. And this actually becomes important. I'll talk about this in a minute. This is a great way to look. The dollar amounts vary, but the percentages sit in the same neighborhood for different types of companies. So if you're a software as a service company, you can look at Salesforce.com, see what their gross margin is, and kind of aim for that same percentage. So the percentage is the cost of goods sold divided by the revenue. So in our case, we would take the $90 landed cost and divide it by the $249 retail price. And that would give us a 64% gross margin. So what we can do, we can look at those gross margins and see the types of companies. So I put in some examples here. So Salesforce.com, this chart actually reads from right to left. So 2015 is on the right, 2018 is on the left. You can see the revenue, the cost of goods sold, and the gross profit. And so the percentages for a pure software as a service company tend to be in the 70s, right? So if you're building a software as a service company, this is where you're probably going to end up if it's purely online. Now, if we look at Walmart, Walmart is a very physical business, right? They've got stores, they've got inventory, there's all kinds of boxes, people moving boxes around, forklifts. So in this case, we would expect a lower gross margin because there's a lot more work going into creating and delivering the product. So sure enough, the gross margins are lower. You see they're in the 20s for Walmart. And for some businesses, they're even lower. For supermarkets, they're lower. They might be in the single digits or low teens. My friend's fish business was only had only a few percent gross margin, but had only a few percent gross margin, but he was doing 9 figures. So even a few percent gross margin was a lot of money. But that's the business, the gross margin percentage varies by industry. And what you can do, you can go online. So any publicly traded company makes their annual report available for free on their website in the investor relations section. So go find some companies that are basically the same type of business that you're starting, and look up, do the calculation, find out their gross margin. They may print it out in the annual report, or you may have to do some math. But I highly encourage that, because then you'll see kind of what you're aiming for. And then when you're putting together your financial projections, you'll know if your financial projections make sense, right? If I'm doing a software as a service business and I go in saying in year 3, my gross margin is going to be 20%, the investor is going to look at me and say, wait a minute, if this is pure software as a service, why aren't you at a 70% gross margin in year 3? Right? So it starts to give me a little bit of a map. Okay, so Google, we think of Google as online, but they actually do a lot of physical products. They have laptops, they have phones, they have tablets. So we kind of expect them to be somewhere in the middle between Salesforce and Walmart, right? Highly virtual, highly physical. The gross margin percentage is probably going to be somewhere in the middle. And sure enough, they come in the 50s and 60s. So probably a little more virtual, a little more tending towards the Salesforce side of things than the Walmart side of things. But the gross margin is dragged down by all the physical products. They bought Motorola. They have some physical products and expenses. And so for Apple, Apple's very physical, right? They have stores, they have devices. They're starting to shift towards services, but that's only been in the last couple of years. So we would probably expect them to be lower than Google because they're very device driven. And sure enough, they come in kind of right between Google and Walmart. And Apple is kind of the ultimate business. It's physical products, which are expensive, but they charge so much money for them that they're able to have high gross margins. They've really done very well at raising the prices of their devices to cover their expenses. Last one, Amazon.com. So, and this, when we think it through, it's a very physical business. There's warehouses, there's shipping things all over the country. There's no stores, but there's also web services is completely virtual. So they have servers that they're paying for, and the giant data centers, but a lot of the business is actually virtual. And then they have some devices. Also, a lot of what you buy from Amazon, they sell from third parties. So they're not necessarily, it's not necessarily their inventory. So let's see where they end up. Kind of around the same place as Apple. And you can see actually their gross margin getting higher, which is really web services, right? Amazon Web Services is causing that increase in gross margin. So again, I encourage you to go online, go to the company's websites, look this stuff up. For operating expenses, these are what you think of as actual company expenses. And there's really 3 categories. There's sales and marketing, research and development, which is building the product and testing the product, and then general administrative, which is your rent, your insurance, your lawyers, your accountants, all of that stuff. Interest, taxes, depreciation, and amortization, I tend not to cover with early startups. But really, just know that EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Eventually, all of this stuff matters. It doesn't matter as much in the first year or 2. And then capital expenses, as we discussed, expensive computers, molds and tooling if you're doing manufacturing, but not the raw materials. The raw materials are cost of goods sold, buildings, land. Again, with most startups, they might have, they definitely have computers. They might have molds and toolings. No one's really buying buildings or land. with most of the companies I work with. So let's go back to the pitch deck slide. And again, let me just paste this to the chat again. I encourage you to download this and use it in your pitch deck, but here's the template I use. And to make it easier to understand, I do a couple things. I show all the dollars in thousands, so I divide all the dollars by 1,000 just to reduce the number of numbers on the screen. And then I take out all the decimals. No one needs to see the cents. They just want to see the dollars. So when you look at this, you'll see, if I look at month 3 annual recurring revenue, it says $17, but really that means $17,000. Right? So I've taken out the decimals and I've divided everything by 1,000. The one thing that makes it a little confusing with paid subscribers and that down here in headcount, those numbers don't have dollar signs, so they're not divided by 1,000. So just be aware of that when you're looking at this template. Again, I'm giving more detail on the first year. So breaking out the first 3 months by month, and then breaking out the following 3 quarters by quarter, and then showing summaries of year 1, year 2, and year 3. And then I'm showing, so what this is, let me just break it down. It's mostly a profit and loss statement and income statement with a few extra items. So we just covered the middle of this. At the top, I put 1 or 2 key metrics. These are the key performance indicators that are driving the business. So in this case, it's the subscription business. So how many paid subscribers I have is very important. And then the annual recurring revenue is how I'm judging my success, right? The paid subscribers turn into ARR. And so this gives the investor a glance into the key performance indicators that I'm using for this business. So this really helps when I'm presenting something to investors. Below that, I have revenue, which we've talked about, cost of sales, which is another term for cost of goods sold, which we've talked about, gross profit and gross margin, which I showed you how to calculate using the cost of sales or cost of goods sold, my operating expenses, and my EBITDA, which is the profit and loss. And then, so we've covered all that. And then I have headcount, because I think it's interesting as an investor, I always want to see how many full-time people do you have? And this line is blurring a little bit. It used to be an employee was an employee. Now there's all kinds of like part-time and contractors. But essentially what this tells me, how many people actually work at the business. And what I can do at a glance, if I look back up at the revenue, so we have 300,000 of revenue in year 1, and then we have 3 million in revenue in year 2, and then 11 million in revenue in year 3. But if I look here, the headcount didn't grow very much, right? We went from 16 people to 18 people to 22 people. Now, it may be that's possible to do, but it may be that if I'm doing, that big an increase in the revenue, as an investor, I may look at this and say, wait a minute, I probably need, this company probably needs to hire more people. This plan may not be realistic. So that's why I like to show it, because it forces, it forces a conversation between you and the investors, because really you're going to use the investor money to pay for this. And if you're not raising money for investors, you definitely want to know what your headcount is, because that's going to be your biggest expense as part of the business. And then the last piece I like to show, again, I mentioned on the income statement, there's not a cash line. The income statement doesn't show cash. It shows EBITDA, which is definitely not cash. So I like to have a cash line because this is how the business lives or dies. So if I'm showing this to investors, this hints at the money I need to raise. See, I'm at negative 482. So I probably need to raise somewhere between 500,000 and $1 million to run this business. And that's really the conversation I want to have with the investor. This is why I need this amount of money, because this is the plan. And then if I'm doing this for myself, I still need to know, how much money do I need to come up with to pay for this, or do I need to pivot my plan so that I'm not losing money, right? So the cash piece is really important on this summary. And so quickly on the cash flow statement, it's always on the cash basis. It answers the question, how much cash does your company have? And again, you can see here, if I look at the EBITDA, it's very different than the cash at the end of the period. So just be aware the income statement is not cash. It removes all the non-cash items. It includes cash from investors or loans, and it includes cash for capital expenses. So this is where the money you raise from investors, the money you borrow from banks, the money you spend on laptops and buildings, this is where that shows up. So it's very important. I won't go too deeply into this. So the question is, why do we need the cash flow statement if we already have the income statement, right? And I think we've answered that because the income statement doesn't show cash. Let's drop back for a second into cash versus accrual accounting and talk about some real world examples. So accounts receivable. The deal is big companies may take 60 days, or they're now saying 90 days to pay you, which is insane. But I'm a B2B company, I signed a big company, they take forever to pay me. So what happens? I'm gonna walk you through 3 months. If they're gonna take 60 days to pay me, that's 3 months. Here's what it looks like. So in month 1, I invoice the client. I record $12,000 of income on my income statement or profit and loss. And I record $12,000 of accounts receivable on my balance sheet. But I haven't taken in any cash, right? I sent the bill, it shows up as income on the income statement. I have this credit for accounts payable on my balance sheet, but I don't have any cash. So month 2, I'm waiting, and I may have to borrow money to pay my expenses or raise money from investors. Like I'm just waiting for this money to come in. And then in month 3, I finally received the $12,000. Nothing happens on the profit and loss. So remember, we showed the income 2 months ago, but now when we actually receive the money, nothing happens on the income statement. I remove the $12,000 from accounts receivable in the balance sheet, and now the $12,000 in cash goes into my bank account, and I can use it to pay back my debts and run the business. So very different things are happening on the income statement, the balance sheet, and the cash flow statement. And that's why they all work together. Another example is accounts payable. So this is kind of the opposite. So in this case, I get a bill from a vendor, and on the profit and loss statement, I record that bill immediately. So it's $12,000 in expenses, happens right then. I also add $12,000 to my accounts payable on the balance sheet, but I don't pay any money. I keep the cash in the bank. This is like the credit card. I spend the money with an IOU, but I haven't actually paid my credit card bill yet. If I'm taking a very long time to pay, I may wait a month. I'm waiting to get paid my accounts receivable. I finally receive the payment from my customer, and then I pay the $12,000 that I owe to that vendor. So again, there's no change to the P&L. I have already recorded the bill 2 months ago. I remove the $12,000 from my accounts payable on the balance sheet, and then I actually pay out the $12,000 in cash. So again, very different things happening on the P&L, the balance sheet, and the cash flow statement. One more example, deferred revenue. So deferred revenue is, So deferred revenue happens with subscription businesses. So if I pay for a subscription monthly, I pay the month, the company receives my cash, I use the subscription for a month. But a lot of times with subscription businesses, I can pay annual upfront. So what happens when I do that is I'm prepaying a year in a lump sum. And the cash is received upfront, but the revenue is only recognized monthly on the accrual basis. So what does that look like? So let's say I'm buying a subscription that's $12,000 for the year, which is $1,000 a month if I pay upfront. So So the company, when I subscribe and pay them the $12,000, they receive that $12,000 for the year up front. But on the accrual basis, they only show 1,000 of that, 1/12 of that, as income on the P&L. The remainder goes to the remaining $11,000 goes to the deferred revenue entry on the balance sheet. But they take in the $12,000 in cash. This is why it's great to be a software as a service company. You get the cash up front. And then in month 2, they show another 1,000 of the 12,000 P&L, and then they subtract $1,000 from the deferred revenue. So no cash has changed hands. This is just accounting. And the same thing happens in month 3. They show another $1,000 of income. They subtract another $1,000 from deferred revenue on the balance sheet, but they're still holding the $12,000 in cash that they got up front. So this is great if you're a subscription business and you can take in money, because then you can run the business off of that cash. You just kind of have a responsibility to the customer to stay in business so that they actually get the service you promised them. And just remember, cash and accrual are just tools. It's a hammer and a screwdriver. There's not one that's better than the other. There's not one you should use. They work together. And just to go through this income statement versus cash flow statement, so you'll see here on the income statement, the P&L, I have 100,000 in revenue, 45,000 in COGS, which leaves me a $55,000 gross profit. My operating expenses are 30,000, so my EBITDA is 25,000. In this case, I'm making money, so I'm going to pay taxes of $8,000, and the net income for the company is $17,000. So on the income statement, things look great. On the cash flow statement, there's some stuff that gets picked up that's not on the income statement. So I start with my net income of $17,000, but then I have accounts receivable, inventory that I purchase, I repay a loan. So it's easy for me to run out of cash, even though on my income statement I look healthy. And this is kind of what happened to my company the first time around. The income statement looked healthy, but the cash flow statement was not healthy, and we weren't really keeping our eye on it, and that's what led to us having to lay people off. We didn't have a cash buffer. And I'll talk about the king of cash buffer in a minute. Quickly, the balance sheet is typically on the accrual basis. It's a snapshot of what your company owns and what it owes. The assets section, what you own, has to match the liability section, what you owe, plus the equity section, which is what the company is worth. And so that equity section is the net worth of your company. So it's kind of like revenue minus cost equals profit and loss. What your company owns minus what it owes equals the net worth of your company, or the value, the theoretical value of your company. So here you can see in the asset column, I have some cash. We have some laptops. So we have $136,000 of assets. We have accounts payable, deferred revenue, and loans of $46,000. We have some long-term liabilities, which is debt that's due more than 12 months from now, of $50,000. So if we subtract the 46 and the 50 from the 136 of assets, we're left with $40,000 of shareholders' equity, because the assets have to match the liabilities and equity. But if we take on more debt, let's say we borrow another $50,000, so we change the long-term liability to $100,000, suddenly the equity is wiped out, and my company is worth negative $10,000. So it's, if you look at WeWork's balance sheet, when they were filing to go public, their shareholders' equity was negative $2 billion, right? So they had destroyed $2 billion of wealth building their business, which is part of the reason they didn't IPO successfully. So this guy was the king of cash buffer. Back when he started Microsoft, Bill Gates had a rule that the company had to keep a year of cash available. Now, they didn't necessarily keep it as cash. They kept it as bonds, certificates of deposit, whatever. But the idea was, if something bad happened, like a global virus pandemic, they had a year of cash to figure it out. And then he just hired the smartest people he could find and figured a year was long enough they could pivot the business. Fast forward 30 years, and he's now the guy who is funding 7 factories that are potentially capable of producing vaccines out of his pocket. The dude knows how to have cash on hand. All right, so we're going to do a few minutes of fun with business models. We may run over a minute or two, but I'll send you the recording if you have to go. This is one of my favorite businesses. So everyone knows about Tony Hsieh, who started Zappos. He didn't actually start Zappos, though. There was another guy who started Zappos, and Tony Hsieh came in a little bit later and took over running the business. The guy who started Zappos, whose name I don't remember, had a shoe store down the street, and he would go look in the shoe store window, see what shoes they had available, go back home, sit at his computer, convince people to buy the shoes, get them to send him the money, and then he would go down to the shoe store, buy the shoes with the money, and send them out. It is one of the most cash efficient business models of all time. And basically the way the cash flow worked was he would take the order, so he takes the money in, purchase the shoes, and then send the shoes to the customer. So the cash comes in first, and then he pays his expenses second. And it was just him. So he didn't have employees. He didn't have an office. His overhead was super low. So if you map that out, I've created some little green bars here. You take the order, you purchase the shoes, you send the shoes to the customer. So you're green the entire time. Great business model. It lives on Amazon.com, the companies that do the drop shipping. So, they take the order, they take the cash, they go find someone else who has the inventory and then act as a middleman. Great business model, cash efficient business model. You don't manufacture anything, you don't own the inventory, you're always in the green if you do it right. And so Amazon has this concept of a flywheel. So I put together a similar flywheel for this business model. So you sell the shoes, first, you take in the money, you purchase the shoes, you send the shoes to the customer. Once you get it going, you probably have to do some work to acquire customers, and that probably costs some money. You got to run some Facebook or Google ads, hire a social media person, whatever it is. But this is essentially the flywheel. And if you get good at it, you may have, if you were starting this business, you might have to spend some money up front on marketing, but you don't have to manufacture anything. The products already exist. As long as you can find buyers, you can make money right up front. And if you get good at the flywheel, you can grow the business. And I think this is a good framework to visualize, when you're putting your business model together. I think you really want to pay attention to the cash flow. So I'm going to run through a couple more of these, and then I'm happy to answer whatever questions you guys have. So if we look at a marketplace like eBay or Uber or whatever, those tend to be more expensive businesses to start, right? So I got to make some software. So someone's got to do that. Then I got to go out and acquire enough sellers that my marketplace is going to work. And typically that's where these marketplaces start, is with the sellers. So if I'm Uber, I need to have enough drivers to drive people around. Then I acquire buyers. So that costs more money. But now I have a two-sided marketplace. Now I can make a sale, and then I got to keep coding the new version, right? So if we look at this, I'm spending cash all up front until I finally make a sale, and then I'm spending more cash to improve my product. So I'm in the red from the beginning. So if I'm going to do this, I may have to go out and raise some money from investors in order to make this work. Or if I really know the market well, I may be able to do the matchmaking just off of a spreadsheet in my phone at first to get some cash in order to start this business. And if we visualize this as a flywheel, my on-ramp is coding the beta and acquiring the sellers and acquiring the buyers, and then I get into my loop. Then I can make a sale, then I can code new version, then I can acquire more sellers, then I can acquire more buyers, and the game is to grow that loop. But it's cash intensive. I need more cash up front in order to do this. So let's look at software as a service. Squarespace is a website designer, purely virtual. So again, I got to do some coding up front. Someone's got to pay for that or spend the time. The nice thing about software as a service is I can sell to customers early. Like I can build a crappy version, and as long as it does something that no one else does, I can make a sale early. Then I've got to code the new version. Then I've got to acquire more customers. So we've pulled the green forward a little bit from the marketplace model because we have to do less work in order to make our first sale. And in fact, with some software as a service, if you just have a prototype, you might be able to go sign customers off the prototype. Like I've seen some companies be really successful taking in enough money early to build this thing without spending money. So again, I did some little red bars so you can see how the cash might flow. And again, I created the flywheel here. So you code the beta, you make your first sale, you code the new version, you acquire customers. So these are frameworks that you can think about. You can make your own as you're sketching out your business model. companies live or die by the cash flow. So I like this because it helps me figure out the resources I'll need along with the responsible financial model. And remember, cash is fundamental. Finance is the language of business. Timing is everything, especially in this virus world. If you have cash, try to reduce your expenses and hold on to it, because who knows when things are going to start to look anything like normal. Again, I will post this once more to the chat. The slide template that I showed you is free along with the walkthrough. So just grab it. And it has a lot of the stuff I've talked about. I will also send out this recording so that you have it. And I'm also available. I emailed, I think, every one of you. So feel free to send me questions or whatever. I am on the verge of releasing this financial model template. So I will let you know when I do. I keep thinking I'm ready, but I'm never quite. I am testing the cool sounding name Rocket Pro Forma. Let me know what you think. And then I'll open it up for Q&A. So feel free. Let me see. I'll just unmute everyone. So feel free to ask questions. I'm happy to stick around a couple extra minutes if people have questions.
Mike, just a quick question. It's Andrew here. If somebody is a startup, they haven't even gone and produced their first product, and they're just thinking about these numbers and putting this together. From what I heard you say, go back and do look at people's annual reports, look at other startups and see how they've done it, and maybe use that as a basis for putting your finances together. The question that's in my mind is, okay, so you do that, but if you're then looking at funding this or getting somebody to put some money into this, how accurate do your numbers have to be? Because surely it can't just be something that you do behind the matchbox,
My answer to that is kind of what I said to Dane to begin with. I think there is value in going through and just understanding, having a mental map of what you don't know. So, just the act of making the first version of the financial model plants in your head, it quantifies in your head what you don't understand. So as opposed to being, there's a bunch of stuff I don't know, you can say, well, it actually turns out that I know most of this, but I don't know what my rent's going to be. I don't know what the insurance is going to be. I don't know what the legal fees are going to be, but I can go figure that out. So that's on the expense side. I think on the revenue side, what I see a lot of people doing is they just make up numbers. Like, I'm going to sell 10 of these things next month, 15 of them the following month, 20 of them the month after that. But it's not tied to any kind of reality or even a theoretical reality. So what I recommend is go try to make some sales. Like, put up a landing page, run some inexpensive ads, and just see if you can get people to give you their email address and agree to buy this thing when you have it ready, right? And how much does that cost? Like, how much are you paying per impression? How much are you paying per click? How much are you paying per sign up? Because that starts to give you some ballpark answer to what it's going to cost to acquire a customer. And by the way, if you can't get anyone to sign up, you may not understand the market particularly well, and then it doesn't matter what product you build. You really need to understand the customer better. The way I've built out the financial model template is the sales have to come from somewhere. So when I do these, I don't let myself just enter 10 in a box. I have, sales coming in from marketing. I have sales coming in. If I'm B2B, I have a direct sales force, and I've actually mapped out, like, I have a hiring plan for the direct sales force. They have quotas. They have ramp up periods. If I'm a founder and I'm selling, that's a sales funnel. So I've put in like 6 of those in my financial model. And so you have to do a little bit of thinking around what are the channels by which I'm acquiring customers versus just saying I'm going to sell 10 of these a month. So I think that's a good step as well. But all of that starts with creating a first draft of the financial model.
Thanks, Mike.
I have a question, Mike, and if you could see already my background.
I love your background.
I thought I was like a big fan.
I have the tattoo.
That's so awesome. I'm sorry, my sister's printing something, so in the background, it's great. But I thought it was a great background for that.
Perfect.
My question is, so as you probably already know, last time we talked, I used your actual financial model. Um, and I think you added the quarter, right, to it as well? Because the one I have has all 12 months and then only the 3 years. And
Yes, I
so
just changed
that one,
that.
right?
Yes.
Okay, so why did you add
Correct.
the 3/4? And one, I guess, just a little testimony. I actually used it, and I don't know if I told you,
Oh,
but
great. Okay.
I won first place for the pitch thing using your financials.
I
And it
know.
was pretty
Congratulations.
easy. Yeah, it was pretty easy for the judges to see that, and they didn't have any questions, so that was pretty good, I guess. But I wanted to know why you
That's
added those
awesome.
3/4.
Yes. Okay. So here is the answer. I actually changed it to quarters to take things away. So hold on one second. Here's the deal. Can you see my screen?
Yeah.
Okay. So here's what I had, which broke out year one into 12 months, and then had summaries of years 1, 2, and 3. And it's actually simple to understand, especially for someone who knows what they're looking at, like an investor. But it's still a lot of numbers on the screen. So in order to reduce the number of numbers on the screen, I condensed the first year into 6 columns instead of 12 columns. So you see the first 3 months broken out, and then you see it broken up by quarter. So you lose a little bit of granularity in those 3 quarters, but it reduces the amount of information on the screen. So you go from this to this, which is a little less overwhelming. That's why.
Yeah, I saw that. Because I was looking and comparing the before and after, and I know you told me you're still working on the thing, and so yeah, I thought that was very interesting how you did it that way. And
Yeah.
could we ask you a question outside of like financial wise, as in just kind of like what you're looking at even now with companies coming out of the pandemic? Or is there industries that you're interested in looking at, or kind of like what you see is growing right now? I think that was one of the questions I sent you through an email.
Yeah. And honestly, the one thing I think is that this is going to take a lot longer to resolve than any of us would like. I hope I'm wrong about that. But when I think about, when is the next time I'm going to feel comfortable going to a restaurant and bringing my family, or going to a movie, or going to a concert, or getting on an airplane, or even walking into the supermarket, right? Like there's all kinds of things that I'm just not going to feel comfortable with for a long time. And I think other people are feeling that as well. Obviously, each one of us will figure this out once we get through the immediate crisis. But I think online stuff works really well. Like purely virtual works incredibly well right now. I think things that deliver products and services to people's homes work really well right now. Certainly financial products work really well right now. Actually, someone was telling me the Google searches for how to invest in stocks just spiked tremendously. So, any kind of fintech is probably reasonably, has a reasonable chance of success right now. But there's other things that are just a giant question mark. Like I said, I was working with a startup that was
I was going to ask you about that one.
Yeah, I mean, it just hit a wall, right? Because we're encouraging people to get into public transportation and on scooters and bikes, shared scooters and bikes, in order to not drive alone. Meanwhile, fast forward to, no one's going to get into public transit. Everyone's going to drive alone, and PS traffic seems to be solved at the moment. So, all right. And we were talking about how do we pivot? Maybe we go from don't drive alone to stay at home. Maybe that's the campaigns that we're running to reward people. So I think you got to get, really creative look at the landscape. I think you have to cut costs, because who knows how long this is going to last or when it stabilizes. And then I think, you got to do some real thinking about what is life going to be like, in 6 months, a year, 2 years.
Yeah, I felt the same way too when this happened. I'm sure if you're familiar, like one of our customers or our target demographic is working with seniors, And so how do you enter
Right.
how do you enter into senior homes without
Yeah.
I'm sure that was a problem. That's a problem with Papa. That's a problem with my startup.
I'm sure.
We all had
Yeah.
to pivot. And so I could totally relate to that mindset of having to pivot and do things virtually. So thank you for that answer.
Yeah. No problem. Yeah, none of us were expecting the world to just stop. Anyone else have questions? I think you're all on mute, but feel free to unmute yourselves. I keep hitting unmute all and it keeps not working. So you'll have to unmute yourself if you want to unmute yourself.
Hey, Mike, this is Armand. Thank you so much for, I'm doing well. How about yourself?
Doing well.
Thank you so much for taking the time to do this webinar. It was super, super helpful. I have one quick question for you. Do you have any pointers on how to present the template while orally speaking? Is there a quick way, instead of just reading from the top down, is there a way you can present this orally that can make it smooth?
I would probably not try to talk through it. You know, I think when you're presenting live, it is a unique moment for you to establish a personal relationship with whoever you're talking to, right? Otherwise, you would just send them an email and they would read the email and read your deck via email. So I think for a lot of the presentation, you want the slides to basically turn the attention back to you so that you can tell the story. So a lot of the times when I'm putting a pitch deck together, I'm actually creating a different version for email than for live. And I'm reducing the number of words on the screen for live. But when you come to something like this, you know, I find I'm better off just to not talk and let the person, you know, give them a minute to absorb it without me saying anything. Because what happens in a live setting when you throw a bunch of words on the screen is people stop and read the words, and they won't listen to you anyway. Another thing you can do if you're comfortable doing it is just send it to them in advance and say, look, here's the financial summary. Let's discuss it when we get on the call. But that way they've already had a chance to absorb it. But I think trying to flash this up on the screen and talk about it isn't going to work very well.
Awesome. Thank you. Thank you.
Yeah. Even after I simplified it, it's still a lot of information.
I made that mistake, so I could agree.
Yeah. I mean, I think like definitely the slide is totally needed. We've had pitch decks without any projections, and investors are like, "Wait, are you guys going to run a business, or you know, what is this?" And so this is super helpful. And again, I just want to share my appreciation with you.
Yeah, great. I'm glad you all have started using this stuff. I also, I'll send out a link after the meeting, but there's also a slide I like to end with called the milestone slide that I like to put as the last slide in the deck. So I'll send out a link to that also, which just talks about, you know, how much money you're raising, what you've accomplished without the investor's money, and then, you know, the key metrics you're going to hit or milestones you're going to hit with the investor's money. And I like to leave that slide up on the screen at the end. Like I make that the last slide because I want that to frame the conversation I'm having with the investor. Look how great we are without you. This is how much better we'll be with you. And P.S., you know, this is how we're going to make you money. Yeah, if you have anything else, if you think of stuff afterwards, I'll send out a little summary and I'll summarize everyone's questions with answers just so you have them. But I'll send out a link with the video. I'll send out, you know, a couple other links. But feel free, I think I've emailed all of you, or you can reach out to me on LinkedIn. Just let me know as you have other questions. And then if you do need a financial model, I swear it's coming soon. It's just, I keep thinking I'm done and then I have a little bit more work to do, but it's coming soon. Thanks everyone. And good luck with the continued lockdown. Hopefully this ends soon.
I know.
Thank you.
Thanks, Mike.
Thanks, Mike.
Thanks, Mike.
Thanks so much.
Thank you, Mike.
Thank you. Have a good one.